we're exactly 1 week into the most significant escalation of our military in the Middle East that we've had in decades. And questions that I've been getting, whether it's from personal advisory clients or institutional clients, how will this not only impact maybe our portfolio, our investment in you, but also how may it impact our plans for the future? So I today wanted to just have a quick conversation with you all. If you haven't met me before or not familiar with me, my name is Breion Rollins. I'm investment advisor located in Houston, Texas, and TRG Financial is our firm. And we focus on conversations just like the one we're having today, making sure that we're able to not only be actionable when something's happening in the market that we may need to respond to, but at the same time, continue our lens for long term and lifetime planning as it relates to our goals and what we do with the market. Now, there are a few things that we do want to address today. First things first, we know the big caveat in the world is oil. Okay. Oil and gas is one of the big players, not only in that region, but here in the United States. And many of you probably have heard, well, there's this strait, the Strait of Hormuz, and all of the oil and gas goes through that strait. And I do want to give you a few details there and maybe demystify on what's happening. And then also how it might impact you at the gas pump, also how it might impact your portfolio. So first things first, about 20% of the oil reserves do go through the Strait of Hormuz. But for the United States, it's a bit different. So the caveat, we produce quite a bit of oil and gas right here in our own country. Actually, quite a bit to where we can service ourselves. We're only roughly about 7% of what comes through the strait actually makes its way to the Americas. Now, that still impacts us though, because those prices are set over a period of time. So just because we have oil and gas here in the United States does not mean that we won't be impacted by what happens there. You might have already seen the price of crude is hovering around $90 a barrel. That's a significant jump from what we had just about 7 to 10 days ago. And if we consider that that rise may continue to happen, the next step will be you'll see that at the gas pump. We've already got several of us, many of us in this environment are living on the margins. The economy has been tough. The most recent jobs report, we had a loss of jobs in the month. That was one of the first signs that we've had a pullback when 54,000 jobs were supposed to be added. We actually had a loss of jobs. So there's a lot of things that are stretching Americans thin. And add on top of that, the conflict that we've got into the Middle East. So those gas prices may rise, some things that are related to the petroleum. Remember, it's not only that petroleum does gas and what we pay at the pump, there are many products and services that also include petroleum in it as well. That may also include some inflationary pressures that are happening there in the market. So what have I been telling clients? We know that President Trump has signaled that we might go into our strategic oil reserves. So that might apply some reduction, some pressure relief here in the United States market. But what may happen as it goes on? Let's say that this conflict goes for more than the 4 weeks that's slated. Let's say it's up to a year, maybe 2 years. We could see prices for a barrel of oil over $100. And it's been several years since we've seen prices that high. You almost got to think back to even pre-COVID before we had prices that high. So that not only will make an impact on our portfolio, maybe we're looking at commodities in a different way. Maybe we're looking at a fixed income sector a different way. All of those details we'll have to consider while we're monitoring. So while oil is the headline, you have to consider deeper on what may happen with your portfolio, especially those investment menus as it gets more challenging in what's happening in our region. Now, the next thing that I often get questions about, or when I'm reading white papers and studying as I prepare for meetings, is what's happening with the deficit. Most of us know that in the United States, we run a deficit often. Our budget is rarely balanced. I think the last time the budget had been balanced, I think was in the Clinton administration, if I'm not mistaken. But since then, we've often ran a deficit as it relates to what our national spending is on versus what we're taking in, whether it be taxes and or tariffs. Now, we're seeing a war footing now in the budget. More dollars will definitely be spent on military spending as we move forward. There has been some studies that say that this could be up to $1 billion a day. I think more recently it was around 900 million, but they say that it'll quickly go to about $1 billion a day in United States spending as it relates to this conflict. That's why there's probably some incentive to, one, have this completed as soon as possible, whatever the actual goals or the details are that we're trying to achieve, or two, If it's more long term, making sure that all of the country understands that there may be some societal pressure that's put on the market, as well as inflation that may come in with all of this additional spending. So, if we're moving from a peacetime model to more of an active replenishment model, what happens is aerospace and defense will be the places that'll spend the most money. So, not only will they spend the most money, more money will be invested into those sectors to make sure that we're able to keep up with the demand of the war. This is separate than what happened with Ukraine and Russia. With Ukraine and Russia, we were selling already existing weapon systems, military supplies that we could send over to Ukraine to support the effort in Russia. We're directly involved in this. Now, while we don't have boots on the ground, they would say, we definitely are doing a lot to get air superiority as well as missile defense. So keep in mind, you'll probably hear more in the headlines about spending dollars there, where that tax revenue goes directly into our military budgets, and that'll have a direct impact on our markets as well as the investment menus that we work with our clients. So, where should people put their money right now? Now, again, this is not investment advice, but it is somewhat of a loaded question. First things first, don't panic sell. When you panic sell, one thing that people don't consider is that you price in your losses. So right now, if you've got a portfolio that you feel like, man, I'm tanking and I got to get out of all these assets, of course, consult your investment advisor, consult the team that works with you on your portfolio. But keep in mind that if you panic sell and the market starts to accumulate again, you've missed out on all of that benefit of having those shares at a lower cost basis. That's why many people, they consider dollar cost averaging one of the best ways to monitor your portfolio. So keep in mind that would be you'll do some similar type of investment at the similar dollar amount over the period of time, and it'll allow you to average out how much you're paying for each one of those investment vehicles. So again, one of the first tips I would say, don't panic sell. One of the second thing that I would say is look at rebalancing your portfolio. Because if you bought in early or you bought in late at a certain and you may be out of balance as it relates, many people look at a portfolio, let's say I should be at a certain age, 70% equities, 30% fixed income, or 60% equities, 40% fixed income. And during a period of time like this, you may see wild variations in the balance of what your portfolio will look at. So consider rebalancing that portfolio also to make sure that you're not outweight in one asset class and underweight in another asset class. Always stick to the guidelines and the investment advice that you've already been given to rebalance that portfolio. And the third thing that I would share is we will see some volatility. The one thing that you can always be promised with the market is one day will not be the same as the next. And during a wartime, it's even more so because not only will the headlines maybe dictate what's happening in the market, the administration will, and also what's happening with the war effort. So don't panic sell, follow those rebalance guidelines. And as you're looking at the headlines, keep in mind that all the time you can understand, go back to your advisor, have a conversation with someone that you trust. And if you have questions for us, we'd love to have a conversation with you. You can visit us at www.trg-financial.com or catch me on Instagram at TRG Financial. And we look forward to talking to you soon.